What's going on, guys? Welcome back to the channel, and in this video I want to talk about how the rich stay rich and pay almost $0 in taxes in a crazy strategy called buy, borrow, die. Now this video may be the most powerful video I've ever made in terms of how to build and leave generational wealth to your children, or to make sure that the least amount of your money as possible gets eaten up by the government and taxes. So if you want to learn more about the buy, borrow, die method, but you also want to know how to start it as a teenager or as a young adult, because you definitely don't have to be wealthy to start this strategy, then watch all the way into the end of this video, as it sure should be a treat to you. If you think you'll find any kind of value in this video, then drop a like on the video for your boy. And also, if you want some free money, go down and click on the public link in the description, where if you sign up and create an account, they will give you a free stock just for signing up. And the first step of the equation to the buy, borrow, die method is obviously to buy your assets, or to have assets that you already bought. And this buy method is a lot simpler than most people make it out to be, because most of the time when you're looking to implement the buy, borrow, die method, you probably have a really long investment timeline, meaning that you probably have enough time to weather the lows and the highs of the market, and you're not going to be worried about buying and selling different securities. So when you're thinking about implementing the buy, borrow, die method, and you want to know what assets to buy, in my unprofessional opinion, I would say that index funds are the best way to go. When you're investing in index funds, you're not trying to decide what companies will still be in business in 30, 40, 50 years, but what you're investing in is overall economies or overall sectors of economies, so that if you really think technology will be a boom in the future, you can invest in a technology-based index funds. Or if you really think that the United States will still be a strong economy in 20, 25 years, then invest in United States S&P 500 index funds. In this sense, you don't have to pick and choose stock. You don't have to read financial statements. You don't have to listen to earnings reports. You are investing in overall markets, and as those markets go up, you will become wealthier, and you need to build a sizable amount of wealth for the buy, borrow, die method to work. But even though the first step is technically over now that you bought your assets, what may be the most important factor in the buy, borrow, die method is the fact that you don't sell. You have to hold your assets for this process to work, because in the event that you buy an asset and you sell it for more money than what you bought it for, you are going to pay capital gains tax on any profit that you make. So if you bought a stock for $100 and you sell it for $110, you will owe capital gains tax on that $10 in gains that you made from that stock purchase. So the biggest key in the buy, borrow, die method is keeping your assets and never ever selling them. And one of the reasons for this that I'm going to talk about later in this video is that you want to borrow against those assets. But what I want to talk about now is that by not selling your assets, you get to let compound interest work to its highest effect on your money. By buying and selling different securities a whole bunch of times, you may think you're working harder, you may think you're investing harder, but in reality, you're losing fractions of percentages on your money that you could have gained had you just held. As I said, every time you buy and sell, you pay taxes. But if you just let your money sit and compound, the interest that your money earns will start to earn interest. And then, as one of my favorite slogans is, your money snowball will start to roll. If you started out with that same $100 and it grew to $110 in the first year, you wouldn't owe any capital gains tax on it because you didn't sell your asset. But also now you have $10 in interest. So in the next year, if your $110 grew by another 10%, you wouldn't earn another $10, but you will earn $11. And the extra $1 is from compound interest. And if you just keep contributing money and you keep letting that money grow, your money snowball will get absolutely huge. But let's stop and talk for a second about a specific account that will allow you to store as much compound interest as possible without having to pay any taxes and not using the buy, borrow, die method. So this type of account is called a Roth IRA, and it is an individual retirement account that allows you to contribute $6,000 annually, with the current promise from the federal government that they won't tax any money that money grows to if you wait until you're 59 and a half to withdraw your money. So with most retirement accounts, the government allows you to deduct the amount of money that you contribute to the retirement account from your current tax bill. So if you contribute $5,000 in the year 2019, your taxable income in 2019 will be lowered by $5,000. And this is called before tax contributions, because you're contributing money before they are taxed. However, with a Roth IRA, how they are structured is that you are contributing after tax dollars, meaning that it's going to be money that you already pay income tax on, or that you will pay income tax on, with the promise, as I said, that you can take that tax advantage later on when you're ready to retire. A quote that I heard that sums this up so good is that, would you rather pay tax on the seed in the case of a Roth IRA, or would you rather pay tax on the tree, which is going to be what your retirement account grows to? And me personally, I think paying tax on a smaller seed is a much better idea than paying taxes on the big huge oak tree. But now let's get to the actual second step of the buy, borrow, die method, and this is obviously going to be the borrow step. So in the buy, borrow, die method, after you buy your assets and after you let them grow to a considerable amount, what you then can do to avoid paying taxes on that money is get a loan using those assets as collateral. So for example, let's say throughout the years your assets grew to $1 million. So you had $1 million in an investment account account somewhere, sitting there earning interest at about 7 to 8% per year. And in this year, you have about $60,000 in living expenses. So in that sense, you need $60,000 in cash in order to fund your day-to-day lifestyle. And I believe that most investors in this situation would just think, hey, I'm just going to sell 60% of my portfolio, and then I'm going to leave the $940,000 left and let that continue to earn interest. However, with the buy, borrow, die method, how you would approach this situation is a little bit different. So in this situation, you can take out a loan using your $1 million investment account as collateral. And with that collateralized loan, you could then use the cash from that loan to pay your lifestyle and use the interest from your investments to pay back your loan. And in that sense, by paying back the loan from the interest on your investments, you could theoretically then rinse and repeat, because the interest that your investment accounts earns should never go over the loan amount in 1 year. So let's do a little bit of quick math to see how that works. For the purpose of this example, let's say you had that $1 million investment account. That's a lot of money. And let's be a little bit more optimistic here and say in one given year, that investment account grew by 8%. And we can expect 8% year over year in this situation. So what we can see here is that your investment account grew to $1.08 million in 1 year, but you needed $60,000 in order to pay back that loan. And what you would then do here is take that interest and pay back the loan and still have $1.02 million left over. In that sense, you're not making earned income. You are getting a loan that you're not taxed on in order to fund your living expenses. And then with this method, your wealth is allowed to continue to grow. And then after this, what you want to do next is just continue to reborrow in order to pay back your loans and never have to touch your actual principal amount. Now, this strategy does get a little complicated, and I don't want you to just take my word from this video and go start to try to do it yourself. So if you're really considering the buy, borrow, die method and you want to know exactly how the borrowing and reborrowing works in order to not pay taxes, now definitely contact a certified public accountant so you can get a professional to run you through how to use your assets as collateral and avoid paying a significant amount of income tax in the process. But at last, you have to get to the last part of the 3-point scenario, and you didn't have to die. But why is die even included in this strategy about how the rich don't pay taxes? And that is because dying actually may save you, or I guess your children in this sense, the most money in terms of taxes. You see, according to the US tax code, when you die and you leave your children or you leave a trust, a portfolio of assets, the next person that takes on those assets after you die will receive them at a step up cost basis, meaning that according to the IRS, they will receive them at the current market value without any gains currently attached to them. So what this means in a real scenario is that if you bought a whole bunch of Apple stock for $5 back in whenever the company opened and they are now worth upwards of $500, when you die and you were doing the buy, borrow method for yourself, you would have $595 of capital gains tax already inherently inputted into that stock. However, when you leave that asset on to the next person, their new cost basis would be $500 per share, not the initial $5, because after you die, it is then stepped up to the current market value. In this way, technically the person that you leave your assets to could then sell off the assets and not have to pay any capital gains tax. However, what should happen in this sense is that the next person will start to buy, borrow, die all over again, and then once their life is all used up, they would then leave another even larger portfolio of assets on to the next generation. But with all that being said, I really hope you enjoyed this video, and I really hope that this video sheds some light on how the buy, borrow, die method actually works. As I said, I know this whole process can be extremely confusing, so if you really want to implement this strategy, then I would definitely recommend contacting a certified public accountant. However, if you did find value in this video, then do me a favor and tap that like button for your boy, and also hit that subscribe button if you want to see more content like this. And if you want to get a free stock to get your buy, borrow, die method started today, then go down into the description where if you sign up to the public app, they will give you a free stock just for signing up. No strings attached, just free money just for tapping on your screen a couple of times. However, with all that being said, I really hope you did enjoy this video, and I'll see you in the next one, guys.